Okay, we should be good to go. Cool. Thanks everybody for joining our Apartments 101. So we hold these sessions about once every half a year or so. And every time I do it, I'll try to bring you guys something new about the current market, etc. And if you have any questions along the way, I love to make this interactive. So feel free to send any questions that you have in chat. And as I'm going through the presentation, I'll also answer things along the way. I think, yeah, I really enjoy making things interactive. And then this is probably the last meeting to two before we start going back to in person. I love to meet everybody. It's more fun that way. But we'll also, be doing a Zoom session, maybe even sharing on Facebook. So anybody who's not local to the Bay Area, more than happy to join us there as well. Okay. So the usual quick disclaimer, we're not brokers, we're not real estate agents, we're not attorneys, we're not providing any legal advice during the session. It's purely for educational purpose. I personally love to share all the little tidbits I learned along the way. So, anything that helps anybody, happy to do it. So as everybody know, periodically we do go out and acquire apartments. So if you're interested in learning about the process, if you're interested in being notified of future deals, feel free to join our mailing list. It is bit.ly /link_newsletter. Okay, so I'll also be sending the slides out and the recording after the meetup. So you don't have to feel like you have to take any screenshots or write anything down. I'll be sending them out. So quick introduction. So today's agenda, we will be going over the management team first. And then I'll give you a little bit update on how the market has been in the past half year. And then we'll kind of go into the more information about what does multifamily look like, single family versus multifamily, what is the difference? We'll talk about how syndications are formed. We'll also talk about the business model of running apartments and why they're valued differently, say than like a single family home. Okay. And lastly, we'll also wrap up with more market conditions, and feel free to send any questions you have. So this is usually end of the year is an exciting time of year. So I know that we have a lot of new people joining us on this session. So what I want to be able to provide to everybody is to share how multifamily works. Commercial, once we get to a larger scale in commercial multifamily, there's a lot more interesting things to learn. So I'm making a series, Apartment 101, 102, 103, and we'll be able to cover different aspects of it, right? So this is Apartment 101. I won't dive into too much of a detail. I'll save that for some of the other sessions. But mainly we'll go over in Apartments 102, we'll talk about like, okay, what is the process of acquiring deals and what that cycle looks like, okay? In the next one, we'll talk about how do we evaluate deals that come to us, right? And how do we project what kind of returns that we can get from these deals? And then 104, we'll talk about our best partner in this business, which is like people who give up millions and millions of money. So commercial lending, how to qualify, how to actually find lenders that will give you money, and what different type of loans are there out there. Okay. Apartments 105 will start covering how to manage a property at scale. What are the things to watch out for? there's a joke I like to say: if you own enough units and you manage them long enough, three things will happen. Somebody will get shot in your property. Somebody will, one of your units will get burned down. You'll have a fire in one of your units, and eventually, unfortunately, somebody will probably pass away on your property. So it's all part of business, and it's learning how to deal with these interesting tidbits, and how to manage the events, right? And finally, we'll talk about something that I'm very happy about and excited to talk about. So we reach an end. How do we sell a property? How do we negotiate the broker fee? How do we position the property for sale? What are the little things that will help increase your value? And also, how do we refinance on these deals and be able to return money back to the investors, right? So all this and more, there's tons and tons of stuff to talk about. This is just like, but I personally feel like, yeah, it's good to share with people. You guys don't have to pay $20,000-$30,000 to the gurus, and we'll be happy to share as much as we can. And along the way, I'll probably come in and also talk about my personal journey. How did I get into multifamily? How did I transition from single family to multifamily? And my experience in doing that. I think a lot of people are in a similar situation and looking to see, how do we, how to get started, right? So. Later on this week, in fact, I'm flying out tomorrow morning to go to Dallas. This is every year there is a Old Capital Multifamily Conference. It's one of the largest in the nation, where all the syndicators, the lenders, the property management folks, people who buy and sell apartments, they all get together for a conference. And this year it's being held at the Texas Ranger Stadium. So it'll be fun, 3 days, basically networking and getting to know the brokers even closer. So, in the future, if you guys want to break into the space, going to some of these conferences is really good way to build up your connections and yeah, meet the people that will either your partners, your future partners, or your future acquisition team. Okay, cool. All right, so a little bit about us, who we are. So we are a team of investors based out of California. We live in California, but we don't necessarily invest in California. We like to invest out of state in states like Arizona, Texas, Georgia, Florida, etc. Right. But our investors are not limited to California. We have investors from all across the nation as well. So far, we are acquired about $35 million worth of assets, about 350 units in total. And we raised about $6 million in funding so far. Together with other partnerships, I also have other groups that I work with in acquisition. And together with the other partners, we're probably closer to 15 properties altogether. So I actually have multiple clubs, so within the Silicon Valley, the SV Mike, this meetup group, we're currently fortunate to have over 800 like-minded people. So once in a while, we'll hold events, bring everybody together, and we'll talk about the different opportunities or where the market is. And if you are, so this meeting was for people who were interested in one of the deals we had coming up. So if you're interested to hear about future deals, as I mentioned before, please join our mailing list. And yeah, this way you can be part of the next invitation. Okay. A little bit about me. My background is actually software engineering. I've been working in the Valley for over 20 years, and I love I love being in small companies. So I'm on my fourth startup right now, and was fortunate enough that two of our startups were able to go public. That was Aruba Wireless, and earlier than that was Altium. So I grew up in the Fremont, Mission San Jose area. Um, this is actually a little bit out of date, but since about 5 to 6 years ago, I have started investing in multifamily. So far, I'm actually passively invested in other syndications. Right now, I have about 12 multifamily syndications that I have invested in, about 4,000 units, and they include units in Texas, in Arizona, yeah, all over the nation. So I'm also invested in self-storage, and also, I also part owner of a business in LA, right? So I've always been very interested in different investment types, and so I kind of spread out the things I invest in, as well as the groups I invest in, to learn as much as I can. Okay. So, during this process, I want to make sure that I got to know who am I investing with, and what is their track record, all that kind of stuff. And that's how we started this local meetup in the Milpitas library. So there were only a few of us, but in the beginning, just 5 people in a little library, and just talking about what are the deals available, and the reputation of syndicators. And eventually, yeah, we grew much larger. Cool. So usually the investment team, you can't do this alone. Multifamily is a team sport, right? So we usually have people that is located at the places that we're investing in. So in Dallas, I have my local Dallas partners, Ken and Wind. And Ken and Win has been a real inspiration to me. So, they started investing back in 2011, and they have actually been acquiring a lot of single family units. So they actually, through this time, they bought about 72 single family homes. Okay. And it was great because it was only like $60,000 to $70,000, per house, right? So they accumulate quite a large portfolio, but it was actually a lot of pain to manage that many single family units, right? To do the taxes, to track all the maintenance and repair. So eventually they realized that, hey, instead of managing 70 something single family homes, why don't I buy and invest in a single 100 unit apartment, right? So you get the economy of scale, you get to have professional property management manage a property for you, and it's actually much more diversified. So Ken and Win actually owns about 15 apartments now, and full cycle about 6 of them. Okay. And this is a year, 2021 is actually a very busy year. Out of all my investments, 5 of them have gone full cycle, including one in my portfolio that I'm selling right now. It's actually on the market. I'll show you guys. So a little bit about the current market trend. I think some of you know that I've been traveling a lot to look at deals, to look for deals to acquire. It's a really hot market right now. So what I'm seeing is, after COVID, there are a ton of capital from other assets, okay, that is moving to multifamily. So I'll give you an example. People who have invested in retail or hotels have really suffered over the past year. So when they look around and then they kind of look at what are what were actually good investments during this time, everybody realized that multifamily did extremely well during the downturn, because in the end, everybody needs a place to live, right? So multifamily over the past year, occupancy did not dip below 92 to 90%. It did extremely well. So a lot of people are catching on to that. So they're selling their hotels. They are selling other type of assets to move the capital into, a much more stable apartments and multifamily. So we're now competing with private equity. We're now competing with other family offices, basically funds that have a lot more cash, and they don't really care as much about the short-term cash flow, right? They want to buy an asset that they can hold for 10 years, 15 years. So, but along with that, we're also seeing very, very strong rent growth. So over COVID, most of the apartments did not try to raise any rent, right? We were just making sure that we hunkered down, we're able to keep the tenants happy and healthy, and nobody really pushed rent last year. So there was a lot of pent-up growth that is being realized now. So across the board, we're seeing, anywhere from 5 to 8% rent growth on a year-over-year basis, which is really high compared to like the usual 3%. The usual is about 2 to 3% rent growth a year. And so this year it's just been phenomenal. In my apartments, we're actually seeing about 10% rent growth on the lease trade outs. So it's very encouraging. Occupancy is really strong. So right now, I think across the multifamily, average occupancy is about 96%. On the two properties, we're at about 99% and 97% full. So it's, the demand is really strong, and this is while we're pushing rent. So it's really good. In terms of financing, things are extremely cheap as well. So with Fannie Mae and Freddie Mac, you're able to get, if you want to borrow $30 million, $40 million, right now you can get rates as low as 2.6%, which is just phenomenal, right? And then they'll lend up to, anywhere from 70 to 80% of the value. And they'll also give you, 3 to 5 years of interest only. Okay. All while the loan is actually non-recourse, which means that if the price of the property ever drops below the loan amount, they can't come after you for the difference. So financing is extremely attractive right now. So as a result, we're seeing that apartments are expensive. So cap rates, cap rate is a way to measure the apartment's income versus the selling price. Okay. So the lower a cap rate is, it means more expensive something is, right? So we're seeing cap rates, where it used to be like 5% for Class B properties, they've gone way down. They're like, so right now it's probably low 4 cap for Class B, or even, into the 3% range. So things are more expensive, but with the financing, the deals are able to be worked. So in September of this year, also a lot of the protections for the tenants are also expiring. So eviction ban is expiring. And then some of the government assistance programs that have been basically encouraging people to stay at home instead of looking for work, those are also ending. So I would say over the past 6 months, one of the most challenging thing has been to find construction workers or maintenance crew, right? Because they probably make just as much money staying at home than it is to coming out to work. right? So it's very little incentive for people to come out. So there has been an extreme shortage of personnel. So nowadays, we expect this situation to improve quite a bit. Okay. So Roger has a question on how do you know which class an apartment is, class A, class B, class C. So I'll actually be covering that in a few slides. So cool. A lot of us are very familiar with single family, right? So some of us own single families, maybe even duplex and even a quadplex, for example. So it's something we're very familiar with. We can get loans yeah. So some of the pros for holding a single family is you have full control. You're the only owner for this for this house, right? So you decide what to do. You decide, how you want to renovate it. You decide when to get a loan, when to sell the property, how to manage it, etc. Right? So single family is also easier to sell, right? So with the MLS, if you list it, you should be able to sell it within a month or two. It's pretty easy to liquidate, and any agent can probably help you with that. Okay. And with single family, it is also easy to, once you have renovated the place, or if the value of the market has gone up, you can actually borrow against that equity and take the money out and invest in another single family, and so on and so forth, eventually building up your portfolio. So it's what we're familiar with and what we're comfortable with. But I think what a lot of people don't realize is the benefits of multifamily. Okay. So we just mentioned that the pros of single family is full control. Well, the con is full control as well. You're now responsible for everything. Okay. So you're responsible for finding the good property management company to take care of the property. Sometimes you're fielding calls to handle maintenance items. You are having to, ask like, hey, where's your rent? All that kind of stuff, right? So, so the con compared to a multifamily is, whereas apartments can afford like a whole leasing agent and maintenance crew to work on your property, you can't afford that with a single family or a low count, number of units, right? When you have to have service calls, you have to hire plumbers or you have to hire outside contractors who is probably going to charge you $80 just to come out, right? So on a per visit basis, the on-site, the service contractors cost a lot more. Okay. So you also don't benefit from better pricing. So when we buy something for apartment, we're buying like 200, 300 pieces, and we're able to get really cheap wholesale pricing. Single families, there are places where you can find like a wholesale discount, but it's not going to be close to what I'm able to get, when we're in a group of, when buying the kind of amounts that we are. Okay. Another thing about single family is, let's say if you own 2 single families, one of the tenant moves out and then you have to wait to find a new person to move in, right? That means you have effectively lost 50% of your income, right? If 2 people move out, you have now effectively lost 100% of your income. And, and maybe one person is not paying, right? He's still there, he's not paying. So any change in income is it's almost binary, right? It's all or nothing. It's actually a lot. But on a typical 200 or 100 unit apartment, I could have 10 people leave, and that would just be like 5% impact to the overall collections, right? So you've really spread out the risk, and you can afford to absorb a lot more ups and downs in the occupancy. And with people leaving here and there, you'll still be able to maintain 95% occupancy. So you'll still be able to collect 90 to 95% of the money. So it's very good in that sense. Okay. So why invest in apartments? I think all of us want to be able to scale up to the size. We want to be able to do institutional size deals, right? To be able to buy these large, beautiful apartments that we can run much more efficiently and charge more money for, right? So, apartments give us ability to do that. And I can't buy a $20 million apartment alone, right? And I don't think most of us, even if we could, want to dedicate our entire free cash to investing into one deal or two deals, right? You don't want to tie up your whole fortune there. So being able to syndicate, being able to share the risk with other people really helps to protect you while being able to really buy these large quality assets. The second thing, which is a main reason why I invest in apartments, is really because it's downturn resistant, right? So, during what I can see is while we go through several downturns, people would sell the house or default on the houses. People will move out of like super expensive apartments and then move into something more affordable, right? So when it comes time to when it comes to a down economy, what we find is apartments are pretty much always full. Okay, well, that may not be true for houses and other kind of yeah. So my goal, my investment philosophy is don't lose money, don't lose money, don't lose money, right? So I'm okay with the kind of investment I'm looking for is one where I don't have to feed it money during a downturn. Okay, I don't want to be cash flow negative during a downturn. And I want it to be profitable when the market is doing good, and apartments fit that profile. So apartments also have a great economy of scale. If you just think about it, if you hire on-site staff, right? Let's say an office lady that works there full time, her cost is maybe about $50,000 a year. That's her salary in Texas. So you're now spreading that cost out over 100 units, as opposed to 10 or 20 units, right? So you'll be able to buy things a lot cheaper as well. Another thing is significant tax breaks. So not many people know this, but Trump actually passed many laws that's very favorable to large syndications, real estate syndications. One of them being, if you make investments through a syndication in a real estate deal, 20% of your profit doesn't have to be taxed. Okay, which is just awesome, right? And ridiculous. The other part is the appreciation that you get from the apartments through your improvements, etc. So those appreciation is long-term capital gain. So you're only taxed at 15% for that appreciation piece, right? And you're also able to get bonus depreciation. So normally your depreciation is like over 26.5 years. We are able to accelerate that within the first few years of ownership. So even though that you are collecting a cash flow about like 6%, 7% a year, on paper, it actually translates to a depreciation loss, and you don't have to pay taxes on that, on those income for the first few years. Okay. And I think I mentioned attractive financing. So okay, let me hop over to okay. So is multifamily much more difficult to liquidate? It actually isn't. So yes, it is harder to liquidate because you're not listing on the MLS. It's not like your usual buyer pool, right? So usually a national broker, somebody like CBRE, Marcus and Millichap, Newmark, etc. They will be the ones listing the deals for you. And the reason why you're listing it with them is also because their clients are these large institutions, right? People with large funds, large equity, right? So these are the investor groups that are buying properties in the 10 million, 20 million, $30 million range. So typically for us to sell a property, we go through a 1-month marketing period, okay, where we give tours on the property, people run their numbers, get their loan pre-approvals. And then once we accept an offer, it's usually about 2 months to close the deal, right? Sometimes even faster than that. So, in the current market, I mean, deals go just like that. So, yeah, so usually it's just more steps to liquidate, but I don't necessarily think it's harder once you know how to operate it. Okay. Mirage had a question. In terms of seasonal inventory, is end of a year a good time to find a property? Yes, actually. So a lot of properties actually come out in the September, November timeframe. Okay. But these deals usually close closer to beginning of next year. The reason being, when you're trying to close a deal during Thanksgiving and Christmas and asking your investors to wire you money at that time, people may be on vacation. So sometimes that make it a little bit harder, right? So, but yeah, deals tend to slow down towards end of the year. Everybody's traveling, nobody's really touring properties, but they pick up in quantity usually by January and February. Does bonus depreciation work for residential properties as well? Yes, it does, with one exception. So you have to run what's called a cost segregation study. And cost segregation study is basically one where a team will go through and basically separate out the assets that depreciate at different rates, right? So for example, windows, walls, the new flooring that you put in, okay, they have to be separated into different categories and then accelerated differently, right? So usually to run one of these reports, so in order for you to enjoy the faster depreciation, you have to provide a cost segregation study. And one of these studies costs about $8,000. For a $20 million apartment, that's nothing. And it's really worthwhile to do because it really benefits the investors. But on the single family, $7,000-8,000 report, then that doesn't really make sense. Okay. I think Dan was asking a partial question about QBI. No, so yeah, I was referring to the cost segregation piece. Okay, moving on. So Roger, let me just hop over to different types of apartment assets. So apartment typically fall into 4 categories: Class A, Class B, Class C, and Class D, right? We don't talk about Class D. That's gangland. That's not what you want to invest in. So we don't even consider that. So apartments are typically categorized based on their age. So, Class A is anything from 10 to 20 years. So anything built after the year 2000 would be considered Class A, Class A minus. You see distinct styles here as well. So Class A's tend to be a mid-rise, maybe anywhere from 4 to 5 stories tall, with sometimes with mixed retail on the bottom, right? So these are usually very nicely furnished, so they have granite countertops, stainless steel appliance. Okay, and yeah, high-end mission-based stuff. So Class B is going to be your 1970s to 1990s build. So these are about 30 years old. These are your garden style with little balconies and everything. So that will be your Class B. And these typically come with black appliances. It has nice amenities, swimming pools. A lot of them actually have laundry hookups inside the apartment. So yeah, and these are usually come with pitch roof, individual AC. So that's your typical Class B. Okay. Class C is basically anything from, usually we consider anything in the 1960s to early 1970s to be a Class C property. Okay. These are the apartments built during that time typically have flat roof. Some properties will have a chiller system that instead of like these individual AC, they have a whole a large commercial grade chiller system that service the entire apartment, right? So you'll probably see like white appliances in these, and they will have laundry rooms instead of like individual laundry hookups. And the Class B and Class C's are usually what we invest in. These are the workforce housing. They're more affordable. They're old enough to a point that, it's time to renovate them. And by renovating them, you can actually get much better income. Okay. So the Class A's, we're now seeing that things built in the 2005, 2006, now is about the time that you can renovate them as well. New style cabinets, Formica countertops, etc. So hope that answers your question. Class A, Class B, and Class C. Okay. And they're pretty distinct from each other in terms of like the kind of rents that they're able to charge. So in Dallas, for Class A, you're looking at $1,500 to $2,000 for rents. For Class B, probably up to about $1,200, and Class C, yeah, about like $900 for like a 1-bedroom. So Class B and Class C usually don't compete with Class A for tenants because the price is pretty significantly different. So yeah. Okay. Any questions so far? Okay, so moving on. So what is a syndication? Like I was saying, now any one of us can actually go and buy a $20 million or even a $50 million apartment on our own, right? Syndication is where a group of investors basically pool their money together to be able to buy a much nicer asset, right? It allows investors like us to be able to scale up to really large, really nice institutional size deals, right? So with syndications, we're able to buy properties in the $50–70 million range, while everybody is still contributing. Usually it's about $50,000 or $100,000 minimum, right? So this is how everybody together. So sometimes we'll see syndications anywhere from like 30 people to 100 people, okay, to be able to buy the property together. That doesn't mean that all the people that are invested in the syndication have to be working on the daily operations. It's not like that. There are lead sponsors that is responsible for the daily operations. And the passive investors really just contribute the money and have the lead sponsors manage the property for them. Okay. So syndications are regulated by the SEC. So these are SEC entities, 506B or 506C. Okay. The difference between these two is with a 506C, you're able to advertise on the internet, on newspaper, etc. Right? So, however, you can only take in with 506C, you can only take in people who are considered to be accredited or have a higher net worth. Okay, so the SEC is trying to protect the grandpas and grandmas from seeing like, oh, great deal, double your money, that kind of stuff, right? And they're not savvy enough to know that they might be going to investments that's not realistic, right? So the SEC basically thinks that if your net worth is north of $1 million, you probably know what you're doing, and it's safe for you to see these ads about investment opportunities. Whereas 506B, 506B, you're able to take up to 35 non-accredited investors. But the thing about that one then is you're not allowed to advertise. Okay, only people who have you have met or have a relationship with can be part of that deal, right? So we usually do 506B syndications. We don't advertise. This is why I recommend that if you guys want to be part of the partnership to invest, join our mailing list, and that's how we can get to know you, and that's how you can be part of the investment group. Okay. So all the members in the syndications are part owners of the asset, right? So let's say we buy an apartment, 100 units. What we'll do is we'll actually form a LLC that holds the apartment, and every member of the syndication is a part owner of that LLC. Okay. So this way, everybody get their proportional share depending on their investment and own the apartment themselves, as well as being protected from litigation or other things. So the LLC is formed to protect the members. Okay. So within the group, there's going to be active sponsors who are the leads and passive partners. Okay. So usually I would say there's maybe 3 to 4 active sponsors and anywhere from 30 to 120, 150 passive investors, passive partners. Okay. Will you add the link to the mailing list here to the chat? Yeah, let me do that real quick, just in case you guys want to sign up while we are talking. Oops. Okay. Cool. So diving a little bit deeper into syndication LLC members, right? So active partners. So the way we like to describe it is, so the active partners are basically the pilots of the plane. Okay, so they're responsible for everything. Okay, from takeoff to driving the airplane to eventually landing, right? And then the passive partners basically pay for the ticket to come along, okay? And they really don't have to worry about operating the plane at all, right? They put their trust in the pilots, knowing that they know what they're doing, and they enjoy all the benefits, right? So, I mean, that's why I like being a passive partner and invested in 12 deals, because I'm able to continue working, okay? I don't have to spend my daytime returning phone calls regarding, broken toilet or this or that, right? I contribute my money and I'm able to get a cash flow distribution every quarter, and so I'm able to average, say, 12, 13% return a year without even doing anything. So all the job is taken care by the active partners. Okay. So the active partners, the pilots in the plane, are also known as deal sponsors, leads, managing partner, principals, general partner, etc. Right. So the passive partners are known as limited partners. Okay. So what do active managers do? Well, they do a lot. So, it'll take them maybe 3 months to a year or even longer, but it's their job to find and find deals, evaluate deals, buy the deals. Once they have a deal under contract, they usually have to put down anywhere from $200,000 to $500,000 of non-refundable deposit to guarantee that they'll close the deal. Okay. They have to qualify for the loan. They had to find investors to join them on the deal. And they had to set up the property management team that will now be in the office and manage it day to day, right? So after the deal is acquired and closed and all that kind of stuff, so they will now be responsible for operating the property for the next 5 to 7 years, however long it takes for the deal to exit. And during this time, doing quarterly distributions of cash flow, doing yearly tax, sending the K1s to the partners on a yearly basis, sending out monthly reports on how the property is doing, and also doing any property tax protest, right? And then finally, when the property is ready to sell, they're responsible for doing the sale of the property or arranging for a refinance. Basically, the active manager take care of the whole life cycle of acquiring an apartment, operating an apartment, and selling the apartment. Okay. Cool. So going to the questions. What's the average contribution per deal for passive partners? So usually syndication deals are around anywhere from like $50,000 to $100,000 as a minimum, right? So depending on the size of a deal, right? So yeah, that's, you'll find deals in the 50, 75, and 100 grand increments. So it's not as much as, say, if you were to buy a single family home, you may need to put down 100 to 200 grand. So, but the good thing is you don't have to work. So Tina asked, let's say I invest and then 5 years later, I want to sell my share. Would I be able to? So let's say you have invested in these syndications, right? So in order for the property to execute the business plan, it usually takes at least 3 to 5 years. So which means that, just like if you invested in a small startup, right? If it's a long-term investments, these are all long-term investments. If you pull the money out, if you go to the startup and say that, hey, I need my $1 million back, that company will probably go under because they can no longer afford to operate, right? So that's why we usually advise people that please only invest with money that you can spare, right? It's not money that you need on a day-to-day basis, okay? So it is possible to redeem your shares, for example, in case of, if you have a family emergency or something like that. So it is possible. You will need the sponsors to agree to the sale, and they will see who else want to maybe buy out your share, for example. So because the syndication, it's a closed offering, so partners can only sell to each other. You can't sell to people outside of this private group. Okay, so but usually sponsors are, so if nobody wants to take over your share, usually the sponsors will buy it and take over your share. Okay, but so, but as you can imagine, that becomes a very difficult thing, and it's not easy for the sponsor to manage this kind of risk. So please make sure that you're ready with money that you can invest with, right? Because I think for any deal, if 1 or 2 years down the road, somebody says, I want to pull my money out, that makes it really, really hard to operate. Okay. What are the pros and cons of investing in syndication versus a REIT? Oh, good question. So a REIT typically invests in a basket of real estates. So for example, when I invest in syndication, I know the exact apartment that we are investing in. I know if it's a Class B, Class C, the location, how do the current income look, what is the business plan. I know every detail about what I'm investing in and what the business plan is, and I'm able to judge for myself whether or not I think this is a good deal or not, right? Before I decide to put my money there. In a REIT, they pick for you, okay? And they may be investing in apartments as well as strip malls, as well as other type of industrial. It could be a more broader mix, and you don't really know what you're investing in, right? So personally, I like to analyze for myself what kind of stuff am I investing in, and do I trust the syndicators, right? So I'm experienced enough to be able to look at their projections and know whether it's BS or yes, that seems reasonable. Personally, syndications, I know what I'm doing. Yeah, I know what return I'm getting and what exactly it is. Yeah. How often do the leads sell the apartments? So usually the goal of these investments is, at least for me, is to sell the apartment when I have doubled people's investments. So let's say on a $10 million apartment, the partners have put in $3 million of their own money to buy the apartment, right? The other $70,000 is the bank. We borrow 70% and then we put in 30% of our own money. So we put in 3 million. So when we're able to improve the property from a value of 10 million to 13 million, we have doubled everybody's money, right? So we put in 3 and we earn the extra 3, right? So that's the goal. The goal is not to turn a $10 million property into a 20 million property. No. The goal is to double our initial investments, which is $3 million. So we might hit that goal earlier. We might hit that goal later. So depending on the market. Yeah. Okay. Could you share what happens and if things don't go according to plan after 5 to 7 years? Is somehow is not where you were hoping? Is it a group that votes what to do next, or is it a sale? So typically a syndication would have raised enough money upfront in reserve to be able to survive downturns, right? But the passive investors have the voting right. Okay, so me personally, I would not invest any deal where I don't have a voting power. That's the way I invest, and that's the way I structure my deals as well, right? So, so if things are not operating the way they want, the passive investors have the right to decide whether or not they want to change the active sponsors. Okay. At the end of certain period, the passive investors also, when it comes time to sell the property or refinance, this is also something that the passive investors vote on. So we decide as a group whether or not we should be selling the property or we should be keeping it and wait for a better time. Okay. Roger, my fear is dishonest members or scams. Any suggestion to avoid this? Yeah. So first of all, you don't have to worry about the other passive investors. Like I said, the passive investors only contribute money, and they don't need to do anything operationally. So they really have no impact on the operation of the deal. It's all the active partners. Okay. And then as well as scams, well, the best way is word of mouth, and also check their track record, right? So for example, I have done quite a few deals. My partners have done quite a few deals. They have also full cycled many deals, right? I'm selling one myself. That I'm doing a full cycle on. So feel free to talk to the people that have invested with us. That's the best way to check, really. Are they doing what they promised? And also, there's a lot of online platforms like CrowdStreet or like capital funding sites. You don't really know who those people are. So I have less faith in those online crowdsourcing sites. And you have to wonder that if their reputation is really, really good, they should have no trouble finding people to invest with them, right? Why are they going to these online portals to look for money, right? Is it because their reputation is not good? People won't invest with them anymore? Because when they go to CrowdStreet, they give away like 5% of the stake in order to use something like CrowdStreet. So why would somebody pay that much money to do that, right? So, okay.
Hey, Tony, just have a quick question for you.
Can you sell your position to another investor though? Yes, you can, right? So you can sell to another investor within your group, but yeah, it's only really rare instances. Yep. Okay. Where does syndication occur in the course of a transaction? So usually we would have already put a deal under contract. So we would have already looked for the deal. We would have the seller would have already accepted our offer. We would have already put in our money, our earnest money, and we would have already done the inspection, the due diligence, okay, before we draft a business plan to present to passive investors. So we would have already done all the checking, have the deal under contract, already researched all the expenses that we would need. We would have gotten initial quotes from all the third-party contractors before we had the final number and present it to the passive investors. So once we have that, we will send out a mail to the people that's on our mailing list, let them know that, hey, we have this deal available. If you're interested, we're going to hold a webinar to talk about the deal, why we like it, etc. Right? So we won't send anything out unless we already have the deal under contract. Okay. Do active partners get higher return rates than the passive partners because they're doing all the work? Yes, so slightly better. So the way that the syndications that I run is, let's say you have invested 100 grand, right? So during the course of the holding period and also on the sale, all the money that's generated goes back to paying back your 100 grand first. Okay, so the investor's investment is returned first. After you have received your $100,000 back, if there's any profit left over, then the sponsors will get a cut of that. Okay, so I think we take, right now we're taking about 16% is our split. So, and this is pretty tough on the sponsors, right? So if you don't do a good job and this project doesn't turn a profit, you would have spent 5 to 7 years managing a property and didn't make anything. But personally, I like that. it really motivates the managing partners to do a good job, right? To really do a good job to get a profitable return for the investors. So, okay, cool. All right, so keep moving. So passive investors, what do passive investors do? So when there's a deal available, you would evaluate the deal and decide whether or not you want to invest into it. Okay, you're not liable for the loan if anything goes wrong. Every month you are just collecting cash flow. You just get checkbox money is what we call it, and participate in the shareholder voting when it comes time to sell. And that's it. All right, so that's how I'm able to hold a full-time job while invested in 12 different syndication passively, right? Because there was no additional work on my side. So it's a great way to also learn about the business. While, you know, I think the whole point is you want to continue to do what you're good at, right? So be that being an engineer, be that, you know, maybe you're a contractor for building. This allows you to focus on what you do best while letting somebody else who's very good at managing assets run the apartment for you. Okay. So for the pilots, right? There's all different kinds of syndications out there. So who do you want to invest with, right? So what kind of pilot do you want? Do you want somebody who's aggressive, okay, higher risk, but also, you know, higher potential for returns, right? So that could be like a new construction deal. That could be, you know, like investing in marijuana plants, you know, so higher risk, but the return could be like 30–40% risk. Or you can invest with somebody who's more conservative, right? Lower risk and, you know, focus on cash preservation. So I am the lower part. I'm more conservative in nature. So the kind of deals and the way I run things tend to be much more conservative. Okay. And, you know, this is just part of what being an active partner is. So you're out there touring properties all day long. You're bidding on properties. You're working with your property management companies to look at what needs to be fixed, how much it would be to renovate the units, you know, what are the large capital items. So we visit a lot of properties. So here's an example of a of a classic Class C unit that we would renovate. Okay, so when you get it, you know, it looks like this, right? And then after renovation, then it looks significantly better. To renovate a unit from this to this is only $3,000. And I'm talking about for the entire unit. So it's very cost effective when done at scale. Okay, so for example, the cabinets, they're just painted. These are the same cabinets painted. The glass backsplash, this only cost me like about $60. Okay, the granite, a 7 feet slab of granite only cost me $99 because we buy them at such scale, right? So super cheap stuff. The black appliance set, so that includes the refrigerator, the stove, the dishwasher. All three together is only about $650 for the whole set. Yeah, and you might ask, like, why is it so cheap? Well, I'm not the only one renovating, right? So across across the metro, you have you have another 400 to 600 apartments that's in the metro, and you know, a lot of these are also renovating. So when we're buying like 1,000 refrigerators. We're buying like, you know, 1,000 granite pieces, right? So the price really drops when we buy in such large quantities. So this is another example of a renovation, painted cabinets. The white is considered the lowest grade. Black looks a little bit better. So, and for example, like this countertop, it's actually not granite. It is actually poured epoxy paint that has flakes in it to make it look like it's granite. And to do one of these countertop is only like $80, so to resurface it is actually pretty cheap. Okay. So yeah, the backsplash is about $60 to $100. Your maintenance guy can put this on in like 20 minutes. Okay, so we don't actually have to pay extra for them. So our full-time maintenance, would just renovate these on the side. So to paint the cabinet doors is about $100. Okay, hardware and fixtures, that includes the gooseneck faucets and everything. That's $300. Black appliance, let's just say with tax, very expensive, $800. Flooring is about $1 square feet installed. Okay. Resurfacing a countertop, about $100. And to paint the whole unit, about $700. So to renovate this entire 800 square feet unit, it's only about $3,000. So tenants love it, so we're able to, between this and this, would you pay an extra $100 a month? Yeah, people would. People really would. But even if you say that, I just bumped the rent by $50, right? So you're able to increase your annual income by 600. Okay, you would easily make the money back within 5 years. But the thing about the commercial real estate is, for every dollar of extra income that you get, translates to $20 more in value. Okay, so this is a concept I had to explain to you guys later, but basically, apartments are valued like a business. So the more profitable you are, the more valuable you are, right? So if you're able to generate an extra, $600 a year, okay, multiply by 20, your property is worth an extra $12,000. Okay, so by doing one-time renovations, you can realize a lot of extra gain. Okay, going to the questions real quick. Is the base of the counter for mica? No, it's actually paint, poured paint. How do you like tenants like the fake granite? They actually like it a lot. It looks so much better than the boring old, countertops. So yeah, these basically are just wooden with a vinyl sheeting over it. So they like it a lot. And it doesn't cost us a lot to have to resurface it. Let's say they ruin it. It's like $80, we can resurface it. Not a big deal.
Hey, Tony, what is the paint on? What's like the
For passive
material?
investors, you mentioned that they can collect checks. What's the average return on your money in the first 5 to 7 years? So it depends on the deal. So usually it ranges from 6 to 8%, depending on the deal. Okay, so if you invest in like a Class A property, then the cash flow may be like 2 to 4%, for example. Okay, so typically the overall return that we see is about anywhere from people are, the overall project on a yearly basis nowadays, it's about 13% return a year, out of which maybe about 6% is actually the cash flow. What do these epoxy paint go on? It's like these wooden counters. Yeah, whatever was there before, you just pour the new paint right over it. Okay, cool. So on a typical deal, let's take a $10 million property, for example. Typically, you can get a loan for 75%. And so that means that we as investment group put down about $2.5 million, right? So, and then we probably will raise another $500,000 to $1 million to do further improvements, to renovate the property, to make the outside look better, etc. Right? So that's about, so the total raise would be about 3 million to, $3.5 million. Okay. So, and then if we're able to, so later, so you can kind of see this breakdown, right? So capital improvements, down payment of 2.5 million. So typically account for 1/3. Okay, so if you buy a $10 million deal, you probably want to bring about $3.3 million, about a third. Okay. So if this property is later sold for say 12.5 million, okay, so we will pay off the mortgage. We will return everybody's original principal return investment, 3 million. So we have a net equity appreciation of $2 million. During these 5 years, we probably paid out another $1 million in cash flow. So altogether, the investors would get $3 million, $6 million back. So if you invested 100 grand, you will get 200 grand back. That's the goal that we shoot for. Okay. So I think somebody was trying to ask me a question, but I couldn't hear them. If I don't hear you, please just go ahead and type your question into the chat. I don't know why I'm not hearing you guys. So this is just another picture of a typical investment. Let's say it's 100 grand, right? So first year you get about $6,000 in cash flow. Second year another 6,000. Third year another 7,000. So even though it's a large investment, but you're actually getting your money back every year. And in the first few years, you're due to the bonus depreciation, even though you have received these money and it's in your bank, you actually don't have to pay taxes on them. So you can take that money and make other investments and get an even better return on your money. So at the end of year 6, for example, you would have collected about $34,000 in, actually, you would have collected about $40,000 in cash flow through the years, plus the property probably appreciated by about $58,000 by the time that we sell, thereby doubling everybody's money. Any questions so far? Okay, very, very dark question. If I pass away, can I pass down my share to my son? Yes. Yes. So it's an equity, right? It's equity, so it follows the typical inheritance structure. Okay. Yeah. Okay. So now I'm going to hop over and talk about the different kind of stuff that I invested in, and how was my experience. Okay. So this was one of the deals I invested in Dallas. So this was a big renovation deal. So whereas we're showing you guys a typical renovation is $3,000, this one was $15,000 a door. They took down walls. They tore things out, right? They tore cabinets out, brand new cabinets. They completely repainted the exterior, redid the clubhouse. It looks awesome. Okay, so this is a large value add, right? So it's also extremely risky. Okay, so during this renovation, they were kicking people out. They were not renewing people's leases because they want to renovate super, super fast, right? So occupancy went from like 90% all the way down to 65%, which was lower than what they projected. Okay, so it dropped so low that the deal almost ran out of money. Okay, so during this time, the sponsors actually jumped in and gave the property a loan to the tune of like $500,000 to make sure that the project can finish. Okay, so since then, with that extra funding, they were able to finish all the renovations, and it rode through that tough period, and we were able to sell in 2021, and we actually doubled our money. So the quality of the syndicators is very important. So I usually like to invest in syndications where the syndicators already have money. Okay, and that's part of the reason, because people who have money, they care a lot about their reputation. Okay, and because this is a reputation business, right? So you have to take care of your investors so that they will want to invest with you on the next one, and the one after that, and the one after that, right? So people who value their reputation will put up their own money to save a deal, to make sure that it survives a downturn. To me, that's important, right? Whereas if you invest in somebody who doesn't have a lot of their own funds, then sometimes it's likely that they'll just throw their hands up and bail, right? So yeah, so this was a good example of that. They hung in there, and everybody got really good returns out of that. So Dan is asking, who was the sponsor for this big deal? It's probably the largest sponsorship group in Dallas. They're called S2 Capital. Okay, S2. So with different sponsorship groups, you also see that they take a much larger cut of the profit. I think they take up to 30 to 35% of the profit. Okay, so yeah, but they do a lot of deals, and they do a much larger scale. So yeah. This one, Las Vegas student housing. So this was one that I checked out. I looked at it and I knew that no, I would not invest in this deal, even though it looks great. Okay, so the business plan on this one was to this is an apartment right next to the University of Las Vegas. So they were converting 2 bedrooms into 2 individual student units. Okay, though the thing that caught them off guard was when they were renovating this property. It was an older property, and when they were renovating, they were actually tearing down walls, right? So when you tear down walls of a 1960s property, you're gonna find asbestos. Okay, and that's what the inspectors found in the garbage. So the city inspector actually goes around to these apartments and look in the garbage, and they take their asbestos meter and then go like, "Ooh, nope, I found a high amount of asbestos. You guys have to stop all renovation work. Okay, you now have to find people who are qualified to handle asbestos, and those people charge 3 times as much, right? And you must now do your entire renovation using crew that's qualified for asbestos abatement. Okay, so as a result, they lost a lot of time on the renovation. Okay, so the renovation continued all the way into October. Okay, so but what that means is, they had like 40 vacant units waiting to be renovated, but the students have already started school. So they're not looking for new housing. They already found their housing. So literally it stayed vacant for the whole school year until next summer. And that hurts. So yeah. So that property did not do very well. So when I went there, I saw all the asbestos covered doors, and then I saw that they have 40 units that are vacant. I was like, oh, hell no. So I decided not to invest in this deal. Okay. So this was a self-storage deal in Milwaukee. So what they were doing is they took over a historical building. They converted it. So this is actually, the historical building was actually used to store some file cabinets and old files, right? So they bought it, and then they were able to, by renovating a historical building, they were able to get a lot of credits. About $1.5 million of free credits that city was offering, right? So, but in order to do the renovation, they later realized that they had to replace all the boilers that's in the basement. They had to dig it out, and that was a lot of work. And that construction went about a year behind schedule. Okay, so now they're finally back up, and they're leasing. So they're doing fine there. Okay. All right. So Isaac had a question, basically. So we're basically doubling our money, including dividend. That's right. So the net amount of money that you receive through this investment as returns is cash flow, which tends to be about 30% maybe, and then 30 to 40%. And then it's cash flow plus appreciation. And together that adds up to be about 100% of your original investment. Here's another one. So I'm a part owner in a plumbing company, not small company. These are like big pipes. Okay, like these are not your home residential plumbing business. This is commercial plumbing business. So original projection, because it was a mom and pop shop that was doing the contracts before. So the original projection was 8% return plus 3% ownership. Okay, so this is one of the first deals I invested in. Sponsors were neurosurgeons, so it fit my criteria that sponsors should already have some money. Okay, however, this deal did not go very well. Okay, this is the first time the sponsors have ever done a deal acquisition, and they didn't raise enough money upfront. Okay, so they only raised enough money, I think it was about $1 million, to buy the business. But what they didn't realize is for these kind of business, you don't get paid until 3 months later or even 4 months later, right? So they only had enough money to buy the business. But during the first month, then your plumbers are going like, hey, I need to get paid. I need to get paid. Where's my money? And they didn't have extra funds. They literally didn't have extra funds to pay the plumber. And they thought that, oh, we'll just collect the money and then be able to pay you guys. But then it took 3 months. So during this time, the plumbers got mad and then they left because they don't have enough plumbers. They weren't able to take on more projects, larger projects. So eventually the business actually did not grow at all. So this was a experience. So yeah, now we're actually selling to to get our original investment back. Okay. So this is a little information about the Texas freeze that we experienced. So I don't know if I have a picture of my original property, but I'll show you guys. So this is one of my property in Arlington, Texas. And as you know, in February, there was actually a humongous freeze, right? So pipe burst and Texas is like 100 degrees now. So it is extremely weird to see this white snow-covered Texas. Okay, so some apartments had it much worse than others. As you can see over here, there's a huge pipe burst and insulation came down. We didn't have anything. So we basically told the residents to, before the freeze happened, to turn on your faucet to a drip to keep the water running so that it won't freeze up. We also kept the swimming pool pump running so it doesn't have a chance to freeze up, right? And whenever somebody had a problem, our maintenance guys were there to handle it right away. So our residents actually did pretty good. We only had 1 or 2 units that had a leak when the pipe, so the water was actually turned off by the city after about 3 days, and then turned back on the day after. So when that happened, there were a couple of units where the pipe has burst, but those were fixed very quickly. Okay, and actually, let me see if I can. I kind of want to see if I can show you guys the other apartment that I'm selling. No, not in these slides, but let me see. So yeah, we're selling 2 in our portfolio. So, I typically give a lot of these presentations and, just helping people to know what is the current economic status and all that kind of stuff. Here we go. Yeah. So these are a couple of the deals. So this is the deal that we're currently selling in Texas. Okay, so we bought this deal about 3 years ago. So it was 143 units. We have 42 partners join us on the deal. And 3 years later, we're actually in a really good position to sell the property. So we didn't have to go the 5 to 7 years. So we're selling it at year 3 with pretty good returns. So right now, this property is real cash flowing like crazy. I mean, it's generating more net income than some of the much larger properties that I've been looking at recently. So it's currently on the market. One thing is there were some storage units, pretty good size storage units, about like 200 square feet in some of the second floor. So we converted those into studios and we were able to rent them out for $720. And it only cost us about 10 grand to do the renovation, but that added a lot of value to the property. Okay, so Dan is one of the investor in Arbitrage. So Dan's asking, can you share an update on Arbitrage? So sure. So we started putting the property on our market beginning of this month. So it's on the market since September. So we've actually had a lot of tours already and a lot of people calling interested in the property. So we're probably going to market it for another 2 weeks or so. And then we'll start doing call for offers. So yeah, so far it's doing really good, especially since our income has been consistent and pretty strong. So we're, compared to when we took it over, our overall NOI is 21% higher than when we took it over. So that's how we're able to ask for the price that we're asking. Okay. If the property reaches your goal, has there ever been a thought to continue to keep the property long-term? Or is it once you double your money, you're out? So definitely, if this property is able to be, has strong cash flow, we will consider refinancing and paying people's principal back that way and still hold on to the property. In fact, that's how one of my first investment was. So that one was acquired in 2016. So it's been doing so well that we were able to refinance and pretty much paid everybody's principals back. And it is still cash flowing and we still haven't even sold the properties. So that's how good. So when the deal is that good, when it's cash flowing that well, yeah, then it's worth it to just hold on to it. So any preference for refinance versus selling the property? It all depends on the investors. There's some people that would prefer that, hey, I want the money now. I want to go buy a Ferrari, or I want to go buy a boat or something like that, right? Whereas there's also other people that want to keep holding it and keep having a steady cash flow. So we have both kinds. I think in general, most people like to sell the property. Okay. In general, most people like to sell the property, but if we're able to return basically everybody's original investment and still have a cash flow, then people will go for that as well. Cool. All right, so going back to this, how does depreciation work for syndication? So we talked about this earlier. So basically, you can do what's called a cost segregation study. Then you can depreciate your windows much faster, right? So for your entire asset, it could be worth $10 million worth of stuff. All of a sudden, you can depreciate a lot of that over the first few years, which matches our investment goal, right? We're not holding on to this property for 30 years. We're holding it on to it for about average of 5 to 6 years. So, which means that we want to see all the depreciation happen within the first few years. So the cost segregation allows us to do that. When you finally sell the property, that's when that depreciation is recaptured. Okay, but you have to take the depreciation no matter what. Right? So the IRS is going to calculate for you. So you might as well take the bonus. It used to be you can only take 50% bonus depreciation. Thanks to Trump, we're now able to take 100% of the accelerated depreciation, right? So in a lot of my investments, yeah, that's what you'll see. It's like, okay, I put down 100 grand, I receive $6,000, and then boom, I have a $80,000 paper loss, which will help to offset any other income I have from rents or from other syndication income. Okay. Do you have a legal team or lawyer to review the syndication contracts for you? The last one I saw was 75 pages and a lot of legal jargon. Okay, so yeah, I mean, that's typical. If you have a hard time falling asleep, I recommend that you read one of these offering memorandums. It's really long, but if you have looked at enough of them, you'll realize that there's only a few sections you need to pay attention to. The rest of it is basically saying that all the different risks that may happen, right? Like, a meteor may hit the apartment and burn it down, right? Or, like a typical startup offering memorandum, it'll list every single risk possible, right? But the sections that you want to actually pay attention to is the partnership agreement, okay? So basically, who has which voting right? How much vote percentage does it take to decide whether or not to sell a property, right? If you think that the sponsors are doing a poor job or they have ran away to Mexico, how many votes does it take to vote them out and bring somebody else in, right? So, you want to read that part. The other part is basically how are the profits split. Okay, so that section is also not that long. They usually spell it out pretty clearly. So for our deals, we typically only take a share of the profit. So let's say 16%, right? 16% is only on the profit. For other syndications, they may say, I take 16% stake of the entire property. And that's very, very different, right? Because now they gave themselves 16% voting rights, and they have 16% ownership, whether the property makes money or not. Okay, so, so, I mean, I have a lawyer to help me draft up these offering memorandums, and I drafted according to how I want to be treated as a passive investor. So I looked at enough of them to know what to look for. So like I said, mainly all around the partnerships, right? Who has what rights, how are the profits divided, and then the voting rights, and these kind of stuff, right? But, if you're unsure about a certain deal you're looking at, or if you're unsure about like the contract, feel free to send it to me. I can help you take a look at it. And I can usually spot when something's amiss or something's not to your advantage, right? So, but just understand that different groups will have their own style, right? And the more experienced a group is, the more advantage they will write to their favor. Yeah. But no, you don't need a lawyer. You don't need a lawyer. You just need somebody who's familiar. And yeah. Okay. Cool. Yeah, I mean, at this point, I welcome, if you guys want to get on the speakerphone and ask questions directly, or you can send it through chat, whatever you like. I'll be here for a few more minutes to help answer questions. Okay. I think I heard somebody's microphone come on.
Hey, Josh, it's Vince. Can you hear me?
Are you looking for Josh? Okay, we'll skip that. Is there any depreciation recapture when you sell? Yes, there is. So at the time of sale, that's when the depreciation is captured. Okay, but unlike a normal depreciation capture, this one is actually capped. I think the maximum that you can be taxed at is 26%. So, there's some people that has a higher income bracket. Even when the depreciation is recaptured, and 26% is probably lower than their highest marginal rate. So it's actually still a benefit. How does depreciation work for investment from IRA account? It wouldn't. So because it's already a tax preferred, a tax advantage account. So this whole depreciation and has no real material impact. For example, like the cash flow that you would get normally, it would go into your IRA account, and that IRA account is already not taxed. So yeah, you wouldn't have to be impacted. How many times or how long did you invest in as an LP before becoming a GP? So I probably invested as a limited partner for about 2 years in about 8 different deals before I started pursuing a general partner. But by that time, I have already built a network of people, and I have my lender lined up. I have my property managers lined up. And most importantly, I had people who are more experienced than me that I'm partnering with already lined up. And so, whereas a lot of people start out by buying smaller properties, so like, for example, 20 units, 40 units, graduating to 75 units, and then 100 units, and so on and so forth. It's okay if you don't have experience. You can always partner with somebody who does, right? So I was able to partner with people who are more experienced than me. They helped me qualify for the loan. And then after they helped me qualify for the loan and close the sale, I did 100% of the management after that. So the first deal I did was 146 units. So I did not go through the managing small units path. Yeah, but I was really passionate about it. I went with people on their due diligence. I went, doing rent comparison shopping, pretending like I was moving to Texas and then trying to get like the neighboring rents. So I did a lot of that homework, went to a lot of conferences to build up my network. So for me to feel ready and for me to have seen a couple of years of what kind of returns the apartments will return, and confident about my ability to do this before I started to buy deals on my own. Okay. Would you invest in Class C properties? Yes. I mean, in fact, one of the properties that we bought was a Class C property. That was that was the one. Yeah, this one is a Class C property, flat roof and everything. And believe it or not, Class C properties actually make more money. So, but would I invest in additional Class C properties? No, probably not right now. I think we have a large enough investment group that we can go for better quality assets. So I'm now looking at newer properties, right? So Class B, A- type of assets. So the thing about Class C property is, while it's very profitable, you can acquire it at a lower cost. It's a lot of work to maintain it. I was happy because I got to see I really went through the school hard knocks on this one. We were on weekly calls. All kinds of issues had to be handled, but it's as long as you have people backing you up, as long as you have other syndicators that are your friends, everybody have resources to be able to help you, right? So I thought that was also key, right? So I have a lot of other friends who are general partners. They sponsor their own deals. We fight with each other like crazy when we're trying to buy deals. But after that, we're all the best of friends, right? So we would share like, hey, this guy does roof super cheap. Hey, who did you use to replace a chiller? We would share this information, and that network is invaluable. Okay. So how many folks are active managers on my team? So usually 3 to 4 people, okay, in total. So for example, you usually don't want to be the only person running a deal. It's too much work, right? And usually within a team, everybody have their own specialized role. So by making sure that you're working with partners, let's say one day if I had to go on vacation, there's somebody to back me up, right? Or God forbid, I get hit by a bus, there's actually other people who are experienced who can continue the operations, right? There's no reason for these deals to only have one person. As a passive investor, I will also feel I'm taking on a large risk if there's only one guy running the deal. In all my experience, I've seen many cases where that one guy who wants to get all the profit for himself eventually becomes overwhelmed by the deal and actually does a much poorer job. So yeah, typically I think 2 to 4 people in a partnership is good. Any more than that actually creates problems because then that's too many general partners that all need to agree on something to work on the property. Is there an active syndication that you're raising money for? And could you dissect it with pros and cons? So I currently don't raise money for other syndications. So to raise money for other syndications, the SEC is actually very strict in that regard. So if you raise money for other people's deal, you need to either have license, you need to have a license to raise money, or you must be part of that partnership with an active role in it. Okay, otherwise you're not allowed to raise money for other people. So I refer my friends to other groups. So if they have a deal that's coming up and I don't have anything to offer, yeah, feel free to to check out other people's investments. And yeah, so usually when I have a deal and I could use more investors, they would return the favor, right? So it's all a big happy family. And I think making sure that the investors have choices and know what they're looking at is a good thing, right? So generally, I know about 40 something different syndications, but in reality, I think there's only 2, maybe 3 syndications that I would invest with. The reason is I've seen a lot of people pump their numbers and they're not actually able to deliver. And I've seen a lot of cases where the partnerships actually, they don't, they are in such a hurry to buy so many deals that they don't have the manpower to run each one successfully. Like there are many syndication groups that are just buying apartments like crazy, right? They're buying like 4 to 5 a year. But between 2 people, not gonna be able to do a good job, right? In fact, recently in Dallas, there was a group that bought about 12 deals over the past 2 years. And because they weren't able to really take care of the property, Fannie Mae actually did an inspection on their property, found it to be in really poor condition, and blacklisted them. Okay, so when you get blacklisted by Fannie Mae, that means you will no longer get any loan from Fannie Mae or Freddie Mac. And Fannie Mae basically forced them to liquidate their entire portfolio because you're blacklisted. I will not do deals with you anymore. So they were actually forced to sell their entire portfolio. And this is really because they were spread so thin. They came out pretty promising. When I invested in one of their deals, that was only their acquisition number 3. But yeah, by the time it was done, they were up to 12, right? It's just crazy. Cool. Is there a step-to-step process for passive investors, or do you send this info and we cut a check? Yeah. Generally, I would say when the contract is signed, let's say that's week 0, right? So week 1 and week 2 is basically doing due diligence, applying for the loan. That's the active sponsors. Week number 3 would be to finalize a business plan. Okay. Week number 4, you would be presenting it to the passive investors. Okay. And then week number 5 and 6 is when the passive investors wire in the money. And then weeks 7 and 8 is when the deals will close. So as far as the passive investor is concerned, all they have to do is attend the webinar or in-person meeting to know to see what the deal is about. They will then get a PPM, which describe the partnership and what and the partnership interest. And then you will wire the money and then you will be done. That's pretty much it. Okay, cool. So let me end it here. So if you find this helpful, please give our meetup a like, or anything helps. I'll also be planning to do these. We'll also do more of these apartment 101 acquisitions. The whole strategies and all these deal cycles, how to underwrite deals. If you find it interesting, then yeah, feel free to sign up for the next meetup. So my goal is to help out as many people as I can. Cool. All right. Thanks, everybody. Have a good night.